well, doing well. I saw Ed here a few weeks ago down in Clearwater, Florida, where I got certification as a tax and business advisor. And I've known Ed for quite some time. We've co-written a couple of books together, but he's one of the top CPAs in America. And one of the things he taught me, he says, when you talk to business people, ask them what their biggest expense is. And they always tell me, well, my wife, my college education, my business, whatever. No, I said your biggest expense is taxes. And they all agree. But Ed, it's an honor to have you on my podcast here. You're a wealth of knowledge, and I got a list of questions here. I'm going to read them and let you just answer them.
Absolutely, absolutely. It's my honor to be here, and I'm happy to talk to your listeners.
Well, I tell you what, the training I got down there from you is invaluable. I've already got a bunch of appointments set up. Hopefully, you're here within the next week or two, and we'll get rock and rolling with the Excel program.
Terrific.
But number one, what's the most expensive mistake that you see taxpayers making?
So this is really it's a pretty easy one when you think about it, and that is failing to plan. We've all heard the saying, if you fail to plan, you plan to fail. And most people think of taxes as a once a year exercise. Sit down with your CPA or your enrolled agent on April 15th, put the right numbers in the right boxes on the right forms, get it filed by the right deadline, and then you get to not think about it for the rest of the year. And for a lot of Americans who just have a W-2 or a couple of jobs and nothing particularly complicated in their finances, that might be the case. But if you're running your own business, if you're investing in rental real estate, if you're managing any size taxable investment portfolio, you get to plan a lot about how much you want to pay and when you want to pay it. And if that's your competitive advantage against the IRS. The IRS says, here is the law. And then we as taxpayers get to decide how do we want to comply with the law. So if you don't plan, that's your competitive advantage and you're giving it up.
Yeah. One of the things I did learn from you, Ed, is tax codes are just a limit on a benefit, and people don't take advantage of the benefits.
Yeah. Yeah.
But
They don't understand what the opportunities are for the most part.
well, everybody says, well, I've had my account for years and years and years. How do you know if you have a good account?
Well, the biggest problem with most accountants is they are rule followers. So at the beginning of the presentation, you introduced me as a CPA. I'm not actually a CPA. I am an attorney by training. So CPAs, people think that accountants are all about the numbers. And that's not really true. Any competent junior high kid can handle the arithmetic in a tax return. CPAs are about following the rules. The debits have to match the credits. The balance sheets have to balance. So CPAs spend 150 hours in college learning how to follow the rules. Attorneys spend 3 years in law school learning the rules so that we can advocate on behalf of our clients. And most CPAs are just going to follow the rules for you. So if you've got a CPA who ever comes to you with an idea to save money, that's a keeper. That's one you want to keep. But I talk to audience after audience after audience, and I say, let me see a show of hands. If your tax guy has ever come to you and said, hey, Alan, here's an idea that I think will save you money. And I speak to rooms full of business owners, sophisticated consumers of financial advice, and sometimes not a single hand in the room goes up.
No, absolutely. I talked to people and I said, when's the last time any of your advisors, any of them, give you any proactive advice? Like the attorney wants they're concerned with wills and documents and trust, things like that. Your financial advisor wants to find the best financial product for you, and the CPA wants the correct numbers for your tax return.
Yeah. The CPAs are recording history. Like I said earlier, they want to get the right numbers in the right boxes on the right forms and then move on to the next client, because a lot of CPA firms, they may have 1,000 different clients. How closely can they monitor your financial situation if they have 1,000 different clients? So what happens is at the beginning of the year, they press a button on their software and it rolls over last year's numbers to
Yeah.
this year's forms. And they just start there, but they never sit down and say, hey, wait a minute. Alan's been operating his business as an LLC, taxed as an S corporation. Is that still the right strategy for him? Is it time to add a C corporation to the mix? Is it time to maybe bring in his wife as a partner in the business? He's been contributing to a SEP. Maybe he's outgrown the SEP. Now, the SEP is people think of the SEP as a primary small business retirement plan. The SEP is a terrible retirement plan. It's awful. It's awful in so many ways. And CPAs don't ask themselves those questions. Clients, taxpayers, if you're investing money, you have an annual review on your investments. Hopefully, you're talking with your investment advisor every quarter. How many business owners have quarterly or even annual tax reviews with their client? They just delegate all this stuff. They say, oh, if it's a tax question, my accountant handles it. And what they're doing is they're delegating a lot of planning and a lot of decision making to the most conservative, risk averse member of their financial team. That's a shame.
Yeah. Well, Ed, tell us, why are you different from other tax professions?
Well, the real difference is the proactive approach that comes from being an attorney. I'm not just looking at the rules so that clients can follow the rules. I'm looking at the rules to help my clients take the biggest possible advantage of the rules. And it's a holistic approach. So what we do at Excel Empire, where I am the chief tax planner, and we don't just have one or two products or strategies. And we all remember the old internet ads. This one weird trick melts pounds away. You remember those?
Oh, yeah.
Well, there are a lot of people in the tax business. They're like hitmen, and they've got one weird trick that melts taxes away. At Excel Empire, we look at everything. We start by looking at your business entity selection. We look at executive compensation. We look at deductible business expenses. We look at employee benefits. We look at retirement plans. And in a lot of cases, people think a 401k or a SEP or a defined benefit plan is the way to go. And we can show them it's not. And we do that using something magic. It's called math. So we'll look at their charitable giving, we'll look at their real estate operations, we'll look at their investment portfolio, we'll look at their estate planning, and we'll look at their exit strategy. If somebody's got a business they're going to sell for 5 or 10 or $20 million down the road, let's start planning now to avoid tax on that. So it is a truly comprehensive, holistic look rather than a series of rat-a-tat-tat. Here's a way to save money. Here's a way to save money. Here's a way to save money. We put it all into a holistic plan.
Well, this echoes to me because this is exactly what I tell people. They think outside the box conventional financial plan. And, 401k, just like you said, it's not the best. The SEP's not the best. Defined benefit is not the best.
No, Ted Benna, who's the benefits consultant who invented the 401k back in 1980, says that he regrets what he's created, and he says it's become a monster.
Yep, he's to be replaced. Absolutely. Yeah. I've got him on video saying that. But we got thousands and thousands of pages of tax code. What can make it easier to understand?
Right. So that's something people are very intimidated by the tax code, which for me is great. That's why tax lawyers drive Jaguars, right? Yeah. But when you look at the tax code, it really, you can condense it to something that's not that hard to understand. It is a series of red lights and green lights. So the red lights are where you stop and pay tax. Code section 61 says gross income includes everything, including the change in your couch cushion and the fiver that dropped between the console and the seat of your car. Code section 1 says here are the tax rates. There are about a half a dozen red lights, very broadly defined, where you stop and pay tax. But then very quickly, the code switches over to green lights, where you can go without paying tax. Section 105B says that if you receive health benefits from your employer, they're deductible to the employer and tax-free to you. So I have business owner clients who have set up something called a medical expense reimbursement plan that lets them write off their daughter's orthodontics as a business expense. There are green lights for charitable contributions, for research and development investments, for real estate depreciation deductions, for life insurance cash values. And the key is understanding where those green lights are. But again, let's get back to the typical CPA. Typical CPAs focus on the red lights. And that's important because blowing through the red lights is what gets you in trouble. But they don't have the time or the training or really the proactive mindset to sit down with you and go looking for the green lights that can help you pay less.
Ed, can you give me an example of what most CPAs don't offer their clients?
So there are all sorts of deductions or strategies that I discuss with clients, and they say, why didn't my CPA tell me about that? I'll use the Augusta rule as an example because I'm starting to see it more and more often on social media. The Augusta rule says that you can rent your house to your business for up to 2 weeks, up to 14 days of tax-free income per year. Now, you got to do it right. You got to follow the rules. You got to dot your I's. You got to cross your T's. So you have to use the house for a business related function. You have to document it. Most importantly, you have to establish a reasonable rental value. There were a couple of tax court cases last year where the court shot down Augusta rule deductions for particular taxpayers because they just picked a number out of the air and used that as their rental amount. So don't pick a number out of the air. Find an appraiser. Pay for a written appraisal from a qualified appraiser. That is how you protect your deductions. But I'll bet that most business owners listening to this podcast right now are thinking, wait a minute, my accountant never told me I can do this.
Yeah. Yeah. You know, everybody says, well, I can go on the internet and find all this. Is it possible to go on the internet or Google your way to tax planning?
So you can Google specific strategies. It's real easy to go online and Google Augusta rule or S corporation or simplified employee pension. And you can find out a lot about the specific strategy. And that's great. But Google is just a tool. And if you don't know how to use the tool properly, you can end up misusing it. So you're not going to get a comprehensive top-down look at tax strategies. You're not going to learn timing, combining, and sequencing appropriate strategies into a holistic plan. You're just going to get the pieces. It's like buying something from IKEA and getting the instructions that say, here's piece A, here's piece B, here's piece C, but it doesn't show how you put them together. And tools are great if you know how to use them. If you're watching your podcast right now on a laptop or a desktop, I'm going to say go to Amazon.com and in the search bar, search for orthopedic bone saw. You're going to be amazed at how many actual orthopedic bone saws you can order for 20 or 25 bucks. Amazon will literally deliver the tool to your house, and now you've got what you need to do your kids' orthopedics. But if you don't know how to use the tool, you bring that bone saw to your 6-year-old who's spraining their ankle, they're going to say, Mommy, what are you doing?
Yeah, right. Well, Ed, we got all these red flags from the IRS. Which ones should we avoid?
Well, that's kind of a trick question because an important part of tax planning is understanding what the potential risks are. First off, IRS audit rates have never been lower than they currently are. Whether this is a good thing or bad thing, Congress is refusing to give the IRS the money they need to do a really good job enforcing the tax laws. And stats show that for every $1 you spend on enforcement with the IRS, the government typically collects between $7 and $9 in taxes. Now, we can have a completely different discussion on whether that's a good thing or not thing, or not a good thing. But audit rates are really low. And a lot of things that people think are red flags turn out not to be red flags. It used to be people thought that the home office deduction was a red flag. And there were a lot of CPAs who would say, don't take the home office deduction because it's a red flag. If your CPA tells you not to take the home office deduction because it's an audit flag, you need to fire your CPA, and you need to do it right now, because that simply has not been the case since 1994. Yet these red flag myths live on. If you're operating your business as a partnership or an S corporation, which is how most small businesses in America are taxed, the overall audit rate is about 0.1%. So there are a couple of advanced strategies that the IRS has specifically targeted. For example, captive insurance is one of them, and they've added abusive captive insurance arrangements to their annual Dirty Dozen list. Well, does that mean you shouldn't use captive insurance if it's an appropriate risk management tool for your business? No, no, it means make sure you do it right. Find a vendor who does it right, someone who dots their I's and crosses their T's, so that it's not an abusive captive insurance arrangement. When I sit down with clients, I will talk about strategies that have a higher risk of IRS audits, but in a lot of cases, the strategies that we use actually lower the risk of audit.
Okay. Well, Ed, just kind of basically, how does your tax planning process work?
So I like analogies. You probably guessed that from the red lights and the green lights. The analogy I use for how the planning process works is the same as what happens if you don't feel well and you go to the doctor. Typically, three things are going to happen. First, the doctor's going to diagnose the problem. If your stomach hurts, did you get some bad blue cheese with your dressing last night? Maybe it's just food poisoning. Maybe it's something more serious like pancreatitis. Maybe it's contagious death cancer, and it's time to start getting your affairs in order. But whatever it is, you got to figure it out. You got to figure out that diagnosis. Second step is to write a prescription. The doctor's going to write a prescription, and that might be for medication, it might be surgery, it might be physical therapy. But in most cases, the problem isn't going to fix itself. Third step, somebody is going to fill that prescription. And Alan, when you're working with your clients, you're going to be the head of filling the prescription. There may be specialized vendors who come in for things like captive insurance or a cost segregation study or an IC disc or whatever the strategy is. But you're the general practitioner, and you are supervising the filling of those prescriptions. So I sit down with a client. I want to have a discovery call where I talk about what their goals are. My job is not just to lower taxes. I got a great plan for lowering taxes. You guys want to hear it? Neil, you're going to love it. Don't make any money. How's that for?
I don't like it. And my noise is, can at least unmute my mic. This is terrible. This was the one I'd ask 1,000 questions, but thank goodness I have Alan Porter. If I didn't have Alan, I would just say I would be going crazy right now. Like I'm being muted. Well, now the sound has kind of gone and we're live here, but go figure someone having my air ducts cleaned. But really what I'm hearing in this is the biggest issue I look at is what kind of business should you be, especially when you're scaling your business? Should you stay a sole proprietorship? Should you be an LLC? Should you be a C Corp? What are the challenges? Where do you see it growing? That's why hiring someone like you or Alan is so important, because guess what? You're going to get some CPA. It's looking at a numbers game. How many tax returns I can get down to make money? They're not looking at, I saved you money on your taxes.
Yeah.
That's not what they're looking for.
No, CPAs look at their own business and they look at how much money they realize for the time they and their staff put into the business. What their clients would prefer them to look at is how much tax savings they've created. So yeah, and somebody like Alan is the general practitioner. He may not need to be the expert in business entities, although that's what his CTBA training has done. But what his job is to put the whole thing together and coordinate it. So he brings me in. I'm like an architect. I'm a specialist. I'm a diagnostician. So I'll interview the client. I want to know what their goals are, because my goal is not just to help them pay less tax. Like I said, great plan for paying less tax. Let's make less money. My goal is to help my clients accomplish their financial goals with a minimum of interference from taxes. So I'm going to find out what those goals are. I'm going to review their tax returns, and I'm going to come up with a diagnosis. I'm going to say, you're overpaying your tax by $150,000 a year. And if that sounds like a lot, I mean, for me, that's Tuesday, finding somebody who's wasting $150,000 a year on taxes they don't need to pay. The second step is to guarantee a savings amount and write a prescription and say, okay, here's what we need to do. You're a partner in a partnership and you're paying employment tax on $1 million of partnership income. We're going to form an S corporation to own your partnership interest, and now you're only going to pay employment tax on $170,000 of income. You're participating in a 401k, but you're never going to be able to save your way to $1 million a year income with that 401k. So we're going to look at a non-qualified deferred compensation plan. We're going to look at hiring your children so that they can make Roth IRA contributions. We're going to do the Augusta rule. We're going to do this, that, and the other. And then finally, we fill the prescription. And Alan is the general practitioner. He's the internist. And we're going to work with a series of specialists, the way an internist is going to refer you to a cardiologist or a nephrologist or a gastroenterologist or whatever medical specialty he's going to refer to. So diagnose, prescribe, fill the prescription.
Ed, it's like, I tell people, especially business owners, says, what's your exit plan? I said, well, what do you mean, Alan? I said, well, when you sell your business, do you want to get a tax deduction or do you want to pay capital gains tax? Well, I want a tax deduction. How are you going to do that? Well, I said, it's not how I get to do that. It's who I know that knows how to do that. And I work with a team of specialists, top CPAs, tax specific attorneys like yourself, and we collaborate to come up with solutions for people's financial problems.
Absolutely. People don't realize that paying capital gains taxes when you sell your business is voluntary. We have lots of ways that we can either completely eliminate, defer, or mitigate the tax on those gains. And the question involves, what are you looking to do with those proceeds? We work backwards and find the strategy that gives you the maximum advantage. Sometimes it means zero tax on the sale entirely. Sometimes it means paying some tax, but it never involves paying 100% of the capital gains tax that the government wants you to pay. You simply don't have to do that. It's the same for most people with estate tax. Not a whole lot of Americans are wealthy enough that they're subject to the estate tax, but if they are, there are lots and lots of ways that you can get out of paying it.
Exactly. Well, Ed, who are the best candidates for each type of planning?
So the truth of the matter is that the tax code is written primarily by business owners for benefit of business owners. So business owners are going to have more opportunities to create tax advantaged income streams, break income off into different entities where you can treat that income differently. People who have real estate portfolios are also really good candidates for tax planning. Anyone who is managing a taxable investment portfolio, whether they're doing it with a 401k or an IRA or just all by itself, can benefit from tax planning. And even if you're just a high income W-2 earner, if you're in the 35% tax bracket or above, there are things that we can do for you to help save money on your W-2 income. But the business owners really are going to be the best candidates, especially as they get ready to sell their businesses. And I talk to someone at least once a week who's got a $50 or $100 million business that they're ultimately looking to sell.
Well, I tell you, we've all heard about all these IRS agents that are to be hired. They're gun coding and all this other stuff. Is this something we need to be worried about?
So this is a little bit of misinformation that's spread on something called social media. And you guys know you can't believe everything you read online. So as part of the Inflation Reduction Act, Congress authorized an additional $80 billion in IRS spending over the next 10 years and estimated that it would let them hire 87,000 new staffers. Most of those new staffers will be replacing employees who retire over the next 10 years. Some of them will be auditors. Most of them will be the people who answer the phones and the bureaucrats and the customer service people who just keep the flow of information moving. Some of them, a few hundred of them, will be new auditors. And some people, truly not in good faith, said, oh, they're going to be carrying guns. It's IRS agents carrying guns. Well, the IRS does have a group of employees called special agents who do carry firearms. There are about 2,000 of them in the entire country. So when somebody says that the IRS is going to hire 87,000 new gun-toting agents on social media, A, they're completely wrong. B, they're arguing in bad faith.
Well, last thing I want to bring up, can you say a little bit about the book that we're co-writing together?
So it is called How to Beat the IRS Legally, and it is an introduction to how the tax system works for most people versus how the tax system can work for a proactive taxpayer with a proactive advisor. And that's you. So most people go to a CPA to record history. Your clients can go to you to work with a collection of tax professionals, investment professionals, and strategists to create a true comprehensive tax plan. It's not a long book. It's not boring. It's really just going to be just the meat, none of the fluff. None of the footnotes and the legislative language that makes navigating the tax code such a slog for most people. How to beat the IRS legally, and that's the key.
Well, and definitely word the word legally, right?
Yeah.
And if you want something else, you go find that. Here's a question I'm going to throw at you: AI. Now, if you use ChatGPT 4.0, because or 4.0, like the small tiny,
right,
or Gemini or Meta, are you going to get at least a little bit more information so you can dig into what your tax accountant's not doing, so that then they can contact? This is a great opportunity for more referrals for both you and Alan, in the fact that, are they doing certain things? Is it giving the information? You guys tried that AI? Because that's another big thing, is it's not right all the time. It's right.
No, AI is not right all the time, especially if it's not been trained on the tax code. There are a couple of high-profile examples of lawyers who used AI to generate legal arguments, submitted them to the judges, and then discovered that ChatGPT was citing cases that simply don't exist.
And that's called hallucination. And
that's
and it's changing a lot more now. But would it be a good way to kind of educate yourself in a little bit by asking those questions to see if they're in the right track? That's what I think.
Yeah, it absolutely, absolutely. It can help you start asking the questions. Remember, Alan asked me a few minutes ago, can you Google your way to tax planning success? And what I said was, you can learn about specific tools, and that's where ChatGPT-O will help you today. But you're not going to learn about crafting a comprehensive tax plan, simply because the internet that trains the chatbots doesn't have that information.
Because they're only finding everything that's on the World Wide Web, and it depends if you're dealing with ChatGPT versus Gemini, which Gemini will not even do, because Gemini has a little bit more of an ethics than ChatGPT 4. Well, I haven't messed with Meta yet. Have you messed with the Meta? Go.
There is a special artificial intelligence for accountants and tax lawyers that's trained on the tax code, on the IRS materials, on all of that stuff. So there are tax professionals who use AI for their tax research. It's less of a risk of hallucination because it's trained on the right material. But again, there's very little that puts individual strategies together into cohesive plans. And that's the real challenge. That's where a professional comes in. ChatGPT and artificial intelligence can make you a little better prepared for that conversation with your tax advisor. But I would say, and granted, I'm self-interested because I want to drive a Jaguar too. You're going to be better off talking to somebody who does this on a day-to-day basis
Right.
than you are looking for an unfair advantage.
Before singularity, right?
Yeah.
Before singularity, and then
Right, exactly.
singularity.
Yeah,
Then,
yeah.
then
You will,
once we reach singularity, then But
I
I
mean,
still think AI
when
will not
Skynet becomes
replace a human.
self-aware, none of this is going to matter.
What'd you say?
When Skynet becomes self-aware, none of this is going to matter.
Yeah, no, well, that it'll all be about what are you going to do strategy wise? Because at the end of the day, professionals like you will always be the strategist, but having as much knowledge to go to the meeting is the most important thing to ask those specific questions. And
Absolutely.
you will find certain things because I have an experience. I was on a call with an attorney looking at all the laws, and ChatGPT answered the question better than the lawyer. So, meaning have all your resources, and Google will put you in a rabbit train. And if you want to learn AI, go to my website, call me. I will teach you AI in a second because that's what I like to specialize because I think it's the next big thing. And I think that, creating those things, creating those aspects, but everyone's going to always want a human being, especially with most of the wealth in the United States. So you guys never have to worry. It's 65
No,
and older, that's 70%. People 65 and older are never going to rely on AI before anything else.
No, they're not. And what wealthy people want more than just information is service. They want somebody finding the information for them. Also, Neil, would you be surprised to learn that in the tax community, academics are already proposing different ways to tax artificial intelligence?
I wouldn't be surprised by that.
Okay, so basically, the fundamental is the same way we would tax robots. So if a robot replaces a factory worker, we tax the robot an equivalent amount that we would tax the worker who was doing that work. We're moving the proposals move the same thing to artificial intelligence. If artificial intelligence at a company replaces 5 knowledge workers, we figure out how much those 5 knowledge workers the company would have paid in tax for those 5 knowledge workers, and we tax the company for the AI instead of the knowledge.
When is that happening?
Around the time of the singularity, I think. Try and get something through this Congress. You can't get Congress to agree that ice cream tastes good.
They did finally agree to the TikTok, right? Isn't that true?
They agreed to force a sale of TikTok, or it's subject to a potential ban. But as long as we've got lawyers and lobbyists crawling through the halls of Congress, nothing is ever quite the way it seems.
All right, Alan. Final thing. Thank goodness the noise. I got to talk a little bit. Go ahead.
Ed is a very, very busy person, and I'm kind of his gatekeeper.
Yeah.
Our tax planning with Excel Empire, we don't charge to do these plans for you. We're paid for it.
We don't charge to evaluate. We don't charge to diagnosis. If you do want to move forward with a prescription, we will charge. And I will tell you right now, you're going to look at that number and you're going to say, wow, that's a big number. The good news is you don't pay that fee. The IRS pays the fee in the form of lower taxes. And you're always going to come out with at least a 2x ROI on your tax planning fee just in the first year. Anything in future years is going to be gravy. So our fee comes out of the tax savings. So don't be intimidated by a large number.
Right. Well, Ed, I really appreciate you getting on this with us. You put out a wealth of information. If you're a high-income individual or a business and you want to get in contact with Ed, go through me. I'll get the meeting set up. I've got a tax estimator that we can possibly fill out a little bit on there and get you a ballpark figure of some of the taxes we can save you. But it's all about information and education.
Yeah, it is. And it's all about not wasting money that you don't have to waste on taxes you don't have to pay.
There you go.
Alan, my pleasure. Thank you, guys. Neil, great to talk to you.
All right. That was the Strategic Wealth Strategies podcast, guys. Take care.